Good afternoon. How are you doing? Long time no see. It's been a month. Holy smokes, it's amazing. I hope everyone is doing well. Hey, this is Craig Modelmog from Cornerstone Wealth Management, and this is this week's episode of Wall Street X's and O's for the week ending May 27th. The last time I spoke with everyone, it was April, and you blink your eyes, and here we are at the end of May. You got to love that. But I appreciate everyone cutting me some slack as I was in Lawrence, Kansas at the University of Kansas's graduation for my daughter. Lots of fun. Ton and I had a blast. Got to see CJ as well, and all is well. But hey, before I kick things off here, let me go through my disclosure, and I have it here. I'm not going to read it verbatim, but I'm going to give you the overview of this. Obviously, all the facts and data and opinions on this show are mine. Everything is believed to be true. I will tell you it is, but I have to put that it's believed to be true. This is not an offer to solicit any type of purchase, sale, or any type of acquisition of an investment. This is not asset allocation advice. This is not investment advice. This is not tax advice. This is not legal advice. You gotta love it anyway, guys. Hey, that is enough. Enough is enough. But hey, before I get going in here, I do have some picks for you. So here we go. As you can see here, this is on Sunday on the Hill, and this is the World War I memorial called the Campanile, in which all the students walk through there. And there's this big, I'll call it a wives' tale, saying if you walk through the Campanile before you actually graduate, you will not graduate on time. So it's a big deal. So all the kids come walking through there. They file two lines. This normally it is packed with people. So this was on Sunday. There's a picture of Lizanne afterwards. This was on Friday night, which was the business school graduation, in which she walked through that. And then we have a pic in here of all the family in Allen Fieldhouse when we got done. So it was a blast. We really, really had a good time, a very good time. And I really, like I said, it was a lot of fun. Lots of fun. So anyway, moving on here. I got a good show today. Top three things, and then obviously things that make you go, first thing, can bad markets be a good thing? Yes, they can, and we're going to talk about that. We're going to discuss recessions versus crashes. I know both frightening, but do they go hand in hand? There's interesting details or facts out there. And then I'm going to give you a quick interest rate update, and then close it out with my ever so challenging from a mental standpoint things that make you go, and be glad I'm not singing for you today. I did that one day. I actually played music one day. For those of you that are tuning in for the very first time, this may be your last time, I don't know, but this is uncut and unedited, like John Daly, the pro golfer. I just grip it and rip it, but it's designed to really be informational focused and to really help people become better investors, which is obviously all of our goals, and to really kind of talk about some of the things that maybe not be being discussed on your major networks and newspapers, and that should be. So anyway, let's get going. How bad markets can be a good thing. Benjamin Graham, he's kind of the father of value investing. It's actually who Warren Buffett trained under. Yeah, there's an interesting fun fact for you. But he's quoted with saying, and I'm going to read it for you here, it says, in the short run, the market is like a voting machine, tallying up what is popular and unpopular. But in the long run, the market is like a weighing machine, assessing substance of a company. So short-term emotions, long-term, what I would call true valuation. A couple key facts here. As long as companies continue to grow their profits over time, the market eventually will recognize the value of companies just from a business standpoint. That also goes for their debt. Okay, but then you also have to consider, is my second bullet point, the really impact of different market scenarios. If you talk about, I always talk about investing through a full market cycle, and obviously we are going into a deceleration in the economy, heading towards a trough economically speaking. And again, it's very challenging times, but in the midst of those times, there are still places to go make money. Okay, obviously bull markets are significantly more fun than bear markets, but ugly markets like we're in right now can really provide significant benefits. Bad markets can be great. See, I can't even read my own bullets that I wrote. Bad markets can be great for growing long-term wealth. Here is the deal. When you execute a set it and forget it strategy from an asset allocation standpoint, and you're not dialed into a global macro approach with the goal of investing through a full market cycle from peak to trough and onwards, there are opportunities that happen in all of these different parts of the economic cycle. That's what we're really striving to do. You've heard me talk for weeks here about how we've been positioned and how I've been working on getting positioned. If I rewind back to October of last year, started to reduce small cap exposure, completely reduced exposure in November. In December, reduced and actually eliminated exposure to large cap growth and technology. Got into reducing international exposure. By the first quarter of last year, international exposure was gone. Emphasis in equities was really large cap, core, high quality dividend payers, utilities, staples, things that hold up during tough market periods of time. Okay. On the flip side of that, during anticipated economic slowdowns, things that perform: US dollar, gold, Treasuries. What's been challenging, Treasuries have been a massive underperformer, and we all know that, and I'm not going to beat on that dead horse, but it's something that, I think we're starting to see the possibility of bonds coming back into play. Obviously, time will tell, and I'm going to touch on that as my third topic of the day. So let's keep going here, moving on here. Recession versus crashes. A lot of people would say, hey, Craig, these are both bad. I'm more focused on, do they happen simultaneously? Or if one happens, does it automatically mean the other happens? I've identified several points here that are interesting, which shows some very different outcomes. And I think you're all going to like these. If you go back to, the first one here, 2008, which was the financial crisis, that was a big one that we all remember. I have some very, very bad nightmares about the great financial crisis. Again, both crash and recession. That was a yes. If you look at the crash of '87, for those of you that were investing back then, I was not. That was my second year of college. So I remember the crash of '87. Didn't really know what it meant, but that was a 20% plus crash in one day. What's interesting? No recession. Interesting, huh? So they do not go hand in hand. Let's go to a 1998 financial panic. We had a big financial panic. We did have a crash in the market. No recession. 1990 was another one. We had a recession in 1990. No crash. That was the inverse of what we had seen. In 2018, we had the Fed trying to normalize rates much like they are now, although in 2018, it was really to get short-term interest rates, which were at that point at zero and had been since the great financial crisis, up to more of a normal rate. Fed Chairman Powell really was aggressively raising rates, and it turned out that he chickened out because the markets crashed, and he took rates right back to zero. Again, or actually, the markets did not crash. Let me restate that here. But we did not, or the markets did crash. Good night. It is Friday, isn't it? Before a long weekend. But we did not have a recession. So in 2018, we did have a correction or a crash in the market, which is tagged in excess of a 20% drawdown, of which we're there right now this year, but we did not have a recession in 2018. If you get to 2020, the global pandemic, this was a big one. The market crashed in March. but it recovered in April. So I don't know. That's why I put the question mark in there. You could say we had both, but again, such an interesting time that I'm not sure that it fits the bill. But needless to say, we did have, from a numerical standpoint, a crash and a super short recession. Okay, onward to 2022. What's going to happen? I do not know. What I do know is, from a data standpoint, and you all know I'm very data dependent, the probability of a recession late this year and the next year continues to rise. So obviously time will tell, and as the data continues to pour in, those are things I'm going to continue to report on. But again, just because markets have been very severely fractured this year does not guarantee we're going to go into a recession. Okay, so you don't just jump to conclusions, is probably really what I'm trying to say. You really have to stay focused on the data and the information that's coming in and make decisions accordingly versus making emotional decisions. So moving on here, interest rate update. Have interest rates peaked? You know what, again, I don't know. Famous last words, my last bullet point, IDK, I don't know. Here's what I do think that we do know. Initially, I think the bond market was very focused on the Fed's aggressive tone relative to inflation. The Fed's been talking a great game. I mean, all these rate hikes, you know, we've had a 0.75% hike, came in two pieces, 0.25% and 0.5% thus far. My guess is we're going to get another 0.5% next month and then one more in July. That's what we know for sure. Obviously, can things change with the Fed? Absolutely. But because of the tone of the Fed really caused interest rates to spike significantly. I've got some great charts here that I'm going to show you here in a couple slides about that. Fast forward to today, I think now the bond market is starting to realize that it's not just about inflation and what the Fed's doing. I think that the bond market is beginning to realize that real growth is beginning to slow, that forward-looking profits are slowing, that forward-looking employment is slowing, and that all of these are past cycle peak and slowing precipitously, as I put here. That's a hard word, precipitously. That's a hard word to say on Friday. But anyway, so I'm anxious to see as we continue to move forwards here, if the bond market, and that being interest rates, continues to flatten, because we're seeing a flattening that's going on in the yield curve, and I'm going to talk about that here. Okay. Here's my first cool slide here. This gives you a good idea where it gives you current yield curve, gives us 1 year ago and 2 years ago, and obviously you can see the difference. I mean, look at this gap. You know, from here, I mean, that's 2% down to nothing. I mean, and that's at 1 year. So you've seen this rise here in a really big fashion, very, very fast. Look, and even if you go 3 years out, and we were at basically, call it 0.5%, and here, you know, we were north of 2.5. So we've really seen some major moves. If you go further out on the yield curve in the 20 and 30 years, you can see, you know, the 20 years, you can see that move. You can also see the 30-year moves. Those are pretty good. Those are sizable. I mean, the further out on the yield curve, though, what I find is interesting, you're seeing about, you know, here, this is probably, and I'm just going to have to eyeball this. This is about 0.75% is my guess, is the increase. You look here where you're below 1.5 up to probably 2.25. These kind of mirror each other from a standpoint of about a 0.75% raise in interest rates. If you go to the 20-year, it's very comparable. Where the big move comes is up front in this part of the yield curve. Why? That's where the Federal Reserve is increasing rates. That's why it's so drastic. Okay, that's why rates have moved so fast. Let's move on. Here's the 5-year Treasuries. You can see what a big move. I mean, this is massive, okay? This is 5 years, peaked out at about 3%, as we can see, very close to that. That's a really, really big move. If you go on to the 10-year, very, very much the same. Here's what we're starting to see, though. You see this little move right here? And let's get to the 30-year. very similar. Big move upwards, but we're seeing things roll over here. I'm going to do this little rollover move. This is what I'm really watching very closely as I sit here and stare at my screen today. We've got the 30-year rate at 2.97%, the 10-year is at 2.74, and the 5-year is at 2.72. You've seen a lot of compression between the 5 and the 10-year, and that, again, 5-year rate, again, just for a quick review, 2.72, 10-year 2.74. So, I mean, we're talking 0.2 apart. You look at the 30-year, and we're about 0.3 away. So it's significantly closer. So I think we could see more compression, I think, as the Fed raises rates. Again, we're going to have to watch and see. There's a lot of this that's very much wait and see, but you know what? We're going to keep going. I'm going to keep reporting on it, okay? Closing out here, and I love this. Things that make you go, great song in the 80s. I'm a big 80s music fan. But question number one, how much wealth in the U.S. was lost in the first quarter of 2020? That's great pandemic. Answer, total U.S. wealth declined by 6.3 trillion. That's with a T, okay? And equity wealth dropped by 7.6 trillion. That's stock market, okay? So U.S. wealth is personal wealth. That's massive, all right? Moving on here. This is where it gets interesting. Question, how much U.S. wealth was added from 2020 through fourth quarter of 2021? So that is basically Q2 through Q4, which is a big fat 7 quarters, okay? I love drawing on the screen. That's why I'm doing it. Anyway, here's what's amazing. Net worth increased by 40 trillion. Net worth increase basically 34 trillion, which is an increase of 36%. Or this was household. This was U.S. household net worth. This was from a stock market standpoint was up 34 trillion. So you're looking at a massive 26% growth. What's happened since the start of 2022? I don't know yet because the data is still coming in, but that's massive moves, okay? I mean, you're talking, again, we were down, 7 trillion, and then you look at the net last 7 quarters, and we're up 40 from a net worth standpoint in the markets, and just it's big. It's really, really big. Moving on here, this is what makes me go, in a big way. Lastly, for comparison purposes, real wealth grew by 55% the entire decade of the 90s, okay? 55%. We saw real wealth grow in the 20s and 30s in 7 quarters by 26% and 30-some%. This grew 55% over a whole decade. From 1922 to 1929, real wealth grew by 43%. Here's what's fascinating. Question, what happened to the stock market after this level of explosive growth? Answer, I'm going to let you figure that one out because I am. I don't know what's going to happen. I'm not sitting here saying the sky is going to fall. But when you look at the growth and the explosiveness of the growth and the amount of growth, okay, you have to keep your eye on that because, it's not normal for things to grow that far and that fast. So we're going to continue to watch that. I promise you that. In closing, I tell you what, number one, it's always great to see you guys. I appreciate everyone's time. As we enter this Memorial weekend, here's my hope. Number one, I hope we can all take time to stop and be thankful and grateful for what we have living here in this country. For those of you that may be listening, for those of us that know people who are either first responders or currently active military, if you are retired active military or retired first responder, I humbly thank you for your service. There's nothing greater that an individual can do, man or woman, than go serve their country and serve the people, which we are very blessed to be here. So anyway, before I keep going on and on and on here, I'm going to shut this down. But anyway, guys, thank you so much. Have a fantastic weekend. It's good to see you. I'll be back on my 2-week rotation here with these. And so for May 27th, 2022, this is Craig Modelmog for Wall Street X's and O's, and I am out. Thanks for joining me.